Let's get right into it. Today, we're unpacking a massive, fascinating clash between historic technology investments on one side and rising geopolitical tensions on the other. If you've been watching the markets lately, you know we're living in a time of just extreme contrasts. On one hand, we're seeing absolute unprecedented wealth flooding into the infrastructure of tomorrow, mostly focused on AI and data generation. But on the flip side, the actual physical world where all this hardware gets built and shipped is facing a level of fracture and friction we haven't seen in decades. So, what does this all mean? Well, today we are going to explore exactly how these two realities are colliding. We're looking at the broader market impact of data and what happens when that data meets an incredibly unstable world.
Now take a look at this number, 500 billion. What's really wild about this is that it represents a massive new AI fund raised by Nvidia, and they've partnered with major Wall Street firms just to underwrite AI compute. That is $500 billion. We're not talking about speculative bets here. This is foundational capital meant to literally build the physical networks of the future. When you have heavyweights like BlackRock, Blackstone, Apollo, KKR, Goldman Sachs, and Brookfield all pooling their resources at this scale, it completely rewrites the rules on the market impact of data. It shows us that processing power isn't just some niche tech thing anymore. It's the absolute bedrock of the modern financial engine.
So, here's our roadmap for today's explainer. We'll start out with the data compute boom, then move into global geopolitical flashpoints, look at where tech meets conflict, and finally wrap up with the global market impact.
All right, part one, the data compute boom.
We're pulling all our insights today straight from this Global News Digest, and I love this because it perfectly captures these two separate yet totally colliding worlds of finance and global conflict. If you scan the headlines here, there's a really stark split. The financial side is just dominated by explosive growth and consolidation in the tech sector, but then you look at the political and conflict headlines and they are marked by literal explosions and strategic standoffs. This digest is essentially our guide to understanding how the market impact of data isn't just about lines of code in the cloud. It is deeply, fundamentally tied to the very real physical world. The big takeaway here is that high-tech infrastructure is absolutely booming right now. Take Foxconn, for example, the tech giant out of Taiwan. They just reported a staggering 35% surge in their quarterly net profit. And what's driving that massive jump? It is entirely fueled by the global demand for high-performance AI servers. It pairs perfectly with Nvidia's colossal $500 billion consortium we just talked about. What we're witnessing is an entire ecosystem, from the chip designers to the manufacturers building the physical servers to the Wall Street firms writing the checks, all moving in complete lockstep to feed this insatiable hunger for data processing.
And you know, this isn't just a flash in the pan. According to the data, over in North America, this digital compute infrastructure has officially cemented itself as a robust, standalone institutional asset class. It's stimulating massive high-tech infrastructure development and deepening liquidity in domestic credit markets. Basically, it's becoming easier to borrow and lend huge sums of money specifically to build data centers, just like you would for traditional real estate or energy projects. Investors aren't just buying tech stocks anymore. They are literally financing the compute power of the future. The market impact of data has evolved so much that compute power itself is now a foundational financial asset.
But, and this is a huge but, this historic investment doesn't happen in a vacuum, and that brings us to this dual narrative. On one side, we have this incredible digital boom. On the other side, it is crashing headfirst into intense physical global friction. Think about it. You can have all the capital in the world to build a data center, but you still need semiconductors, you still need advanced cooling systems, and specialized servers. All of those physical parts have to be manufactured, assembled, and then shipped across a globe that is, quite frankly, under severe geopolitical stress right now.
Which leads us right into part two, global geopolitical flashpoints. This breakdown really brilliantly illustrates the sheer volume of political instability we're dealing with today. Over in Eastern Europe, ongoing strikes are causing severe damage to actual infrastructure. In the Middle East, there's a major mutual defense pact that was just signed in Mecca between Saudi Arabia, Turkey, and Pakistan to counter regional threats. And that's happening alongside a really tense US-Iran diplomatic deadlock. Then, looking toward NATO and the US, we're seeing intelligence warnings about potential incursions that could actually test NATO's Article 5 defense commitment. We're even seeing domestic corporate pressures. The House Oversight Committee is pressuring Goldman Sachs to sever ties with its former chief legal officer over reputational risks and past corporate connections to Jeffrey Epstein. So it's a landscape defined by both heavy external conflict and incredibly intense internal corporate scrutiny.
And when we dig into the source data, we see very tangible physical destruction. We're not just talking about diplomatic disagreements here.
Ukrainian long-range drones have targeted major oil refineries in Tatarstan and Novorossiysk, severely impacting Russian retail and logistics networks. On the flip side, Russian forces are using ballistic missiles to exploit regional air defense shortages, striking key Ukrainian ports in Odessa and Zaporizhia. Throw in maritime warnings near the Strait of Hormuz due to territorial tensions, plus U.S. intelligence warning of small-scale physical or cyber incursions designed to test NATO, and you get a picture of a global logistics network that is under extreme physical duress.
Moving on to part 3, where tech meets conflict.
This quote, pulled straight from the source, is honestly the absolute crux of our entire explainer today. I really want you to think about this for a second. You cannot build a $500 billion digital AI network if you can't physically ship the critical electronics you need to run it. The data compute boom requires incredibly specialized, very delicate physical components. If maritime routes get compromised in the Middle East, or if European transport hubs are blown up, the entire financial model behind that tech boom is put at massive risk. The market impact of data is ultimately completely tethered to the physical logistics of the globe.
To give you a concrete example, the source notes that port damage along key European rivers, like the Danube, continues to introduce localized supply chain and transport friction. That directly threatens the transport of vital goods and hardware. When a regional air defense shortage leads to a destroyed port, the ripple effects go way beyond the borders of that conflict. It's a domino effect. It delays shipping, it drives up insurance premiums for maritime transport, and it creates massive bottlenecks for the entire global tech manufacturing base.
And finally, part 4, the global market impact. So what's the big picture? Well, the market impact ripples out everywhere, forcing structural changes across global economies. Because of this sustained military tension, we're seeing dampened foreign direct investment near NATO's borders, which really limits the long-term economic outlook across Eastern Europe. European nations are facing growing fiscal strain simply because they're being forced into a massive structural pivot toward national defense and energy security. Meanwhile, in the Middle East, landmark defensive realignments are signaling deep geopolitical shifts that are going to reshape future regional capital flows. And looming over all of this like a dark cloud is the persistent friction near vital trade corridors, like the Strait of Hormuz. That constantly threatens shipping lanes and risks renewed spikes in global energy prices. And guess what? If energy prices spike, the cost to run those massive AI data centers skyrockets right along with it.
And it's actually super surprising, but even pure digital assets aren't immune to this broader market unease. Just look at Bitcoin. You'd think a decentralized currency would be a safe haven right now, but the source specifically notes it's facing downward pressure. Even with high futures trading, the actual everyday demand for the asset is negative. It just goes to show that when global physical and financial markets experience this level of geopolitical friction, even the most deeply digital asset classes feel the heat. Everything is connected.
So I'm going to leave you with this final thought to chew on. As hundreds of billions of dollars pour into the abstract, highly lucrative world of data and AI compute, can this digital future truly thrive while the physical world it relies on remains so deeply fractured? We are actively trying to build the infrastructure of tomorrow on the supply chains of today. And those supply chains are actively being tested by conflict. It is a fascinating, incredibly high-stakes balance, and watching how the market impact of data navigates these physical roadblocks, well, that is going to define our financial landscape for years to come.